Imagine walking into a bank, dressed well, confident smile, solid credit score, and still walking out without a loan. Sounds ridiculous, right? But it happens. All the time. Why? Because having good credit is only half the battle. So, what exactly are lenders really looking for? And how can you use your good credit to actually get the best personal loan deals? Stick around, because by the end of this video, you'll know exactly how to do it and how to avoid the traps that catch even the smartest borrowers off guard. Number 1. What is a personal loan, really? Let's start simple. A personal loan is money you borrow from a bank, credit union, or online lender, and then pay back in monthly installments, usually over 1 to 7 years. It's unsecured, which means you don't need to put up your house or car as collateral. So the lender relies mostly on your credit score, income, and debt to decide whether to lend you money. Here's a quick example. Let's say you need $10,000 to pay off some high-interest credit cards. You apply for a personal loan, get approved at a 9% interest rate, and now you're paying just one predictable monthly payment instead of juggling 5. Sounds like a win, right? It can be, but only if you get the loan on the right terms. Number 2. Why good credit alone isn't enough. This surprises a lot of people. You might have a great credit score, say 720 or above, and still get rejected. Why? Because lenders also look at your income, your employment history, your existing debts, even the type of loan you're requesting. Imagine this. You earn $4,000 per month, but your rent, car payment, and other debts eat up $3,000 of that. Lenders call this your debt-to-income ratio. And in this case, it's 75%. Most lenders want it under 36%. So even with great credit, a high debt load can wreck your chances. Number 3. Pre-qualify without hurting your credit. Let's say you're shopping around. You see 5 different lenders offering loans. Should you apply to all of them? Nope. Too many applications can hurt your credit. But here's the trick. Use pre-qualification tools. Most legit lenders offer soft credit checks to show you your potential rate before you actually apply. Example, you visit a bank's website, enter your info, and it shows you a personal loan offer at 8.5%. You haven't committed to anything, and your credit score hasn't dropped. This lets you compare offers without the risk. Number 4. Shop around like a pro. Different lenders equal to different deals. Don't just accept the first offer you see, even if it looks good. Some online lenders specialize in offering lower rates for people with good credit. Others charge extra fees that can make a low rate way more expensive. Use aggregator websites to compare interest rates, fees, repayment terms, and perks like flexible payment dates or no early payoff penalties. Here's a good analogy. Imagine shopping for a car. Would you buy the first one you see on the lot? No? You'd check around, compare prices, and look for the best value. Your loan deserves the same attention. Number 5. Understand interest rates and APR. Interest rate and APR are not the same thing. The interest rate is what the lender charges for borrowing the money. APR, annual percentage rate, includes the interest plus any fees, like origination fees. So a loan with a 7% interest rate, but a 3% origination fee, might actually have an APR of 9% or more. That's the number you want to compare. Let's say lender A offers 8% interest with no fees, and lender B offers 7% interest with a 3% fee. The better deal? Probably lender A. Number 6. Choose the right loan term. Longer terms equal to lower monthly payments, but they also equal to more interest over time. Let's say you borrow $10,000. With a 3-year term at 8%, you might pay $313 per month and $1,280 in interest total. With a 5-year term, you might pay only $203 per month, but nearly $2,200 in interest. So, ask yourself, do I need lower payments right now? Or can I handle a bit more each month to save big on interest? Your answer should guide your term. Number 7. Watch for hidden fees. Some lenders sneak in extra charges like origination fees, 1 to 8% of the loan amount, late payment fees, prepayment penalties. Always read the fine print. Example, if you borrow $10,000 and there's a 6% origination fee, you're only getting $9,400, but you still have to pay back the full $10,000 plus interest. So that low rate can become a sneaky trap. Look for lenders who advertise no fees or show clear breakdowns. Number 8. Boost your approval odds before applying. Let's say you're not in a rush. You want to look perfect on paper. What can you do? Pay down some existing debt to lower your debt-to-income ratio. Make sure your credit report is error-free. Avoid applying for other loans or credit cards in the meantime. Consider applying with a cosigner if your income is low. Here's a quick story. Jessica had a 730 credit score, but a lot of student loans. She paid off one credit card and waited 30 days. Her approval odds went way up, and she got a better interest rate. Tiny moves equal to big results. Number 9. Decide how much you really need. More isn't always better. If you only need $5,000, don't borrow $10,000 just in case. Why? Because you'll pay interest on every single dollar, whether you use it or not. Also, lenders might view a larger loan request as riskier, even if you have good credit. Figure out your exact need, down to the dollar. Round it up a little for safety, but don't overdo it. Example: if your medical bill is $4,800, maybe borrow $5,000, not $8,000. Number 10. Have a clear repayment plan. This is huge. Before you sign anything, ask yourself, can I afford this monthly payment every single month? Do I have an emergency fund in case something goes wrong? Can I pay it off faster without penalties? Treat your loan like a short-term tool, not a long-term burden. One smart tip: set up autopay. Many lenders will knock off 0.25% from your interest rate if you do. That's free money. Number 11. Beware of personal loan scams. Scammers love targeting people searching for loans. Watch out for red flags like guaranteed approval, no credit check at all, upfront payment required before receiving the loan, suspicious email domains, or pushy phone calls. Example: someone named Lender1123 emails you saying you're approved for $15,000. Just send them $150 to process the funds. Run. Stick to well-known lenders. If it feels shady, it probably is. Number 12. The secret sauce. Most people miss. Here's where most people stop watching. But this is the game changer. Lenders want to lend to people who don't really need the money. Think about it. If you seem desperate, low savings, high debt, unclear goals, you're risky. But if you show stability, a plan, a budget, and smart use of credit, you look like a low-risk, high-trust borrower. It's not just about credit scores. It's about the full picture. Here's the twist. The better you manage your money today, the easier it'll be to borrow tomorrow. On your terms. That's the real secret. Number 13. Check if you can use the loan for your purpose. Not all personal loans are created equal. Some lenders have restrictions on how you can use the funds. For example, certain loans are meant only for debt consolidation or medical expenses. If you try to use a debt consolidation loan to fund a vacation, you could be violating the terms of the agreement. That can lead to penalties or even early recall of the loan. So before applying, confirm with the lender that your intended use is allowed. A simple call or chat can save you a huge headache later. Number 14. Understand the impact on your credit score. Taking out a personal loan affects your credit score in a few ways. Initially, your score might dip slightly because of the hard inquiry during the final application. But if you make on-time payments and reduce credit card balances using the loan, your score can actually go up over time. Example: David had 3 maxed-out credit cards. He used a personal loan to pay them off. Within 6 months, his credit utilization dropped, and his credit score went from 690 to 740. That's a win. Number 15. Review your loan documents carefully. Once you're approved, don't rush to sign. Loan agreements can be full of legal terms, fees, and conditions you might miss if you're not careful. Look for the final interest rate, the exact monthly payment, the full repayment schedule, any fees or penalties, early payoff conditions. Don't assume everything you saw in the offer page matches what's in the contract. Read every page. Ask questions. Take your time. This is your money. Protect it. Number 16. Consider a local credit union. Credit unions often offer better rates and more flexible terms for borrowers with good credit. They're not for profit, so their goal isn't to squeeze out every cent. Plus, they might be more understanding if your income is inconsistent or if you have unique financial goals. Example: Sarah got denied by 3 online lenders. Her local credit union approved her at a lower rate and even helped her set up an emergency savings account. Sometimes, smaller really is better. Number 17. Look for lender perks and benefits. Some lenders offer extras that make your life easier. Think of free credit monitoring, hardship programs if you lose your job, skip a payment options during holidays, interest rate discounts for good payment history. These might not seem like a big deal up front, but they can be life-saving during tough times. Always check what support the lender offers beyond just handing over the money. Number 18. Don't overlook online-only lenders. Online lenders are becoming increasingly competitive. They often process applications faster, offer lower overhead costs, and approve loans more quickly than traditional banks. Example: Nate applied to an online lender at 8 p.m. on a Friday. By Saturday afternoon, the money was in his account. But always check reviews and verify their legitimacy. The convenience is great, but security comes first. Number 19. Time your application wisely. Timing can make a difference. Applying right after a credit limit increase or a debt payoff can give your profile a boost. Avoid applying for a loan right after changing jobs or making other big financial changes. The more stable you look, the better your chances. And your rates. Example: Amanda waited 2 months after her promotion before applying. That extra income boost helped her qualify for a lower interest rate. Number 20. Personal loans are not free money. This should go without saying, but it's worth repeating. A personal loan is not a bonus check or a gift. It's borrowed money with interest, and it must be paid back. Before you commit, ask yourself, is this loan solving a problem or just creating a new one? Use loans to build, not bury your future. Be honest with yourself. Be strategic. Be smart. Let's wrap this up. If you've got good credit, you already have a strong foundation. Now you know the rest of the steps, from understanding APR to avoiding junk fees, and from comparing offers to making a smart repayment plan. But here's a question for you. What's the number one reason you're thinking about getting a personal loan right now? Let me know in the comments. I'd love to hear your story.